the United States dollar is depreciating. There's a lot of talk about gold, silver, precious metals as a cash alternative. Where's the best place for your money? That's where the money goes. Welcome to How to Retire on Time, a show that answers your retirement questions. We're here to move past that oversimplified advice you've heard hundreds of times. Instead, we want to dive into the nitty-gritty because, well, frankly, there's no such thing as a perfect investment product or strategy. There are certain things you just need to know, so we want to dive into that. As always, text your questions to 913-363-1234 so we can feature them on the show. And remember, this is not financial advice. This is just a show, so do your research. David, what do we got today?
What are some safe places to put money that can still grow other than cash?
It's a great question.
Is this where the mattress comes in? What if I throw it under a mattress?
Yeah.
Is that what happens?
That's probably the worst.
Okay, it's the worst option. We got that out of the way.
If I had to guess, a reason why this question's here is because the United States dollar is depreciating. It's not going the right way. Okay. It's losing its value.
So that means if I went on vacation somewhere, it doesn't spend as far? Or?
Mm-hmm.
Okay.
Yep. Europe just got more expensive. Mexico just got more expensive.
I should have gone sooner.
Yeah. So there's a lot of talk about gold, silver, precious metals as a cash alternative. And there's a good argument for that. I mean, if you look at turbulent times, gold typically does really, really well. When you look at prosperous times, gold doesn't do very, very well. So it is somewhat cyclical, so be careful of that.
Is that all like psychological? Like why does gold not do well in prosperous times?
Where's the best place for your money? That's where the money goes.
Oh, okay. So depending on what's happening out there, where's the best place for it to go?
Yeah.
And if everybody's, having a good time and all is well.
Well, yeah, and there's a big push right now. And it's interesting in the push, if you are a conservative, there's some very politically charged language on why you should buy gold right now. And if you're left-leaning, if you're more liberal, there's some very politically charged language for you to buy gold. Either way, people are being scared into buying gold. Now, gold has done extremely well over the past couple of years. I'm not knocking it, but it's not protected. It can go up and down in value, and the intrinsic value isn't like a business. It's the perceived value of a rock that has a finite amount on this planet.
So do you actually have to get the gold bars in your home, or are you just holding on to it?
People do, and they get conned into all sorts of things like, oh, well, this is gold, so you could melt it down and do it, but this one was stamped in a weird way, so it's worth more. Oh. Yeah, and Beanie Babies were worth more at some point.
Right.
So my opinion is if you're buying gold, I have no problem with that, but don't get caught up into the collector's version of gold. Buy gold for the value of gold. You can do it through an ETF if you want, or you can buy gold bullion and put it in your safe, or if you're like Ron Swanson from Parks and Rec, bury it in obscure places around your property or whatever. But you need to understand that gold is not principal protected. So usually cash is intended to have protection with growth potential. When I say growth potential, to hedge against inflation.
Yes.
That's it.
Yeah, so under the mattress, it's losing money because of inflation.
Yeah.
But if you put it somewhere else, then there's lots of different... Well, tell me where I should put it.
There's really two groups when I consider protection with growth potential, which is a lot of what people would want when it comes to cash. There's three things we all want with investment: growth, protection, and liquidity. If you want growth and protection, you have to give up liquidity for a certain period of time. Mm-hmm. Now, do you need access to all of your money at any given point? No. Because this year you need to live, and next year you need to live, and the year after that you need to live. So you can kind of ladder out liquidity, but still protect parts of your portfolio so that you know it's there in the future.
So if you had like your emergency fund, like I got to have that now, that is somewhere that's you can grab it. It's very liquid, but the rate's lower.
Exactly.
But the money that I need to live off of in 5 years, if I have it tagged as such, it can be earning more, but it's just not liquid.
Yeah. So here are some options. You've got really two camps. You've got fixed and you've got indexed. So in the fixed camp, you can get a fixed rate from a CD. You can get a fixed rate from a treasury or a bond. Just be careful. The better the rate, the more risky it is. So, I mean, if you bought, let's say, a treasury, you're getting 4% or so. Maybe you buy a corporate bond, you're getting 5%. I'm making up numbers just to prove a point. If you buy a corporate bond at 10%, that would be called a high yield bond, aka a junk bond that's at risk of defaulting to where you don't get your money back. So be careful of how much risk you're actually taking for that. Okay, but a bond is as good as the creditor that backs it. So a treasury is as good as the United States government's ability to pay. A corporate bond is as good as the entity that pays the corporate, the bond, the debt. You're taking on someone's debt.
Mm-hmm.
Private credit is a private version of a bond. You have to meet certain accreditation requirements, but that's a possibility. So you've got that. And then you got fixed annuities, which is basically a CD from an insurance company.
Mm-hmm.
Okay. Then you've got index products. You've got buffered ETFs, which anyone can buy those on their own. You don't need a licensed financial advisor to buy a buffered ETF. There's a couple of companies that are really, really good. Calamos, First Trust, a couple of them out there. I have no allegiance to any of them. Just do your research. You've got fixed index annuities, which are more appropriate for those that are 60 plus, because you can't take the funds out unless you're older than 59 and a half years old, or else you get penalized.
Mm-hmm.
Structured notes, as long as the principal is protected, there are some triggered notes that could blow up in your face, so be careful of that. But those are some options where you've got protection built in. It's illiquid for a certain period of time, but you've got maybe more growth potential than a cash account. Build your plan first. Then you need to go into the efficiencies, tax efficiency specifically, and so on. And then you can start to build out your portfolio. How much needs to be protected? What's right for you? What's going to help you sleep better at night? What's the liquidity you need in different seasons of your retirement plan? What's the growth look like? Can you outgrow inflation and have more flexibility in the future? I mean, what if in 10 years we all want to buy a very expensive robot that follows us around all day long?
Yeah.
That's a reality. I mean, 20 years ago, we didn't think we'd have personal computers in our pocket that we live off of.
Right.
So we don't know what's going to happen in the future. I believe in growth and flexibility, not locking up assets for lifetime income. Though you may want some of that. I recognize some people want some guaranteed income. That's fine, as long as we define things as they are. But there needs to be some sort of flexibility and growth overall.